Hello, everybody, and welcome to My Print Hash for week 20 of 2026. I'm your host, Cameron Otsuka, alongside Matt Dines. This week, a little bit as a follow on to last week, we've seen a flurry of headlines related to the digital asset space. So, what we're broadly calling crypto, but, again, as always, we really
I
focus
hate
on
that
Bitcoin.
term. You
Yeah,
know,
we're.
we hate it. Yeah.
But just to describe the broader ecosystem of stablecoins and other assets out there, um, digital assets, fine. But we wanted to put together a framework for you all to understand how all of these headlines that keep coming out might actually fit into that broader plan that I think if some of you might remember, Treasury Secretary Bessent laid out his 333 plan. The goal there was 3% real growth, 3% deficit, cutting down to a 3% deficit, and the equivalent of an additional 3 million barrels of oil equivalent of domestic energy production. It's a pretty meaty goal to go after. I think if you put me in that seat, I'd be a little bit lost to be fully frank. But Besson has a couple of qualities, some attributes that might make him a unique fit, right? He's comes from the macro hedge fund world. He's an economic historian. I think he's got some unique talents for that. But we're going to dive a little bit deeper into some of these headlines and how they might relate exactly to what Besson's pushing there on that 333 plan. And then fundamental, to all of this that we're going to talk about today. Genius Act, Clarity Act, we've touched on them in previous episodes. We're not going to go super deep on those acts specifically today, but I did want to lay out, I don't want to see in the comments, you guys forgot the Genius Act, you guys forgot Clarity. We know they're just not going to be the focus of today's episode. So, anyways, I've laid out the plan. Matt, let's flip over to you. I'm really curious, in your mind, what is Bessent's attempt to accomplish this, very aggressive 333 goal? And what are you trying to watch to track his movement towards that final goal?
So go back to Inauguration Day, January 2025, and just listen to what Scott Bessent has been saying, the core of the message this entire time. I know we get caught up in the actions like Iran, Venezuela, et cetera, and it's hard to get your bearings. But if you don't start from what he's been telling you from the very get-go, none of the developments can make sense. So you got to start with this as your foundation, and it all goes back. This is February 3rd, 2 weeks on the job. What does Scott Bessent say? We're going to monetize the asset side of the U.S. balance sheet for the American people. That's the policy. Like that, like think about the 2024 election as a referendum on the future monetary path of the United States. Because when it comes down to it, we'll make that argument, but I think it's pretty clear now. That's what that election actually was. It wasn't Harris, Trump, whatever. It was these two different frameworks for what the monetary transition that needed to happen would ultimately look like. Um, and this is where Bessent, when he talks about this thing, we're going to monetize the asset side of the federal government's balance sheet. What does he mean by that? Think about stablecoins as private money issuance. We mean that commercial bank issuance or similar financial sector issuance, but it's non-government, right? They're for profit or, just private businesses. But everything we've seen and stable coins, talked about Genius Act, Clarity Act coming up, digital assets, regulations, all these executive orders, those are your milestones, like pushing this project forward of what Bessent's talking about here ultimately. We're going to monetize the assets of the federal government's balance sheet. What it means is it's a new dollar. It's going to be a different dollar. And if you zoom out over history, like from day to day or year to year, the dollar looks the same. But you get these big transitions over the course of the United States' history where our definition of a dollar changes. And that'll pull the social order, the political order, the economic order, everything. And the world is anchored on a dollar standard. It means the U.S. is going to pull the world along with it, in my opinion. Um, so the monetary framework that lost the 2024 election was kind of this next iteration of a public money or like fiat dollar framework that we've all kind of gotten our heads wrapped around, especially as Bitcoin and Bitcoin culture has ingrained the word like fiat money and into the culture. But that's what's on the way out, and the next iteration of that would have been CBDCs,
Interesting.
the public money route. You've seen from other camps. We're not going to focus on that today, though.
I think the assumption here is that, or at least in Bessent's view, that Trump admin view, that Bessent's view or path is better. So maybe explain why they might view it that way, and exactly how that might play out.
So number one, this Bessent path that we've chosen, the electorate chose it. It really stops the progression of this existing system's perpetual credit expansion. Like it's dead in its tracks at this point. We're moving on to the next thing, and we're we're literally living through that transition. Um, but you say, why is it better? So the end game for that perpetual credit expansion model that outgrows the economy's productive resource capacity, it results in these imbalances. Scott Bessent also talks about correcting imbalances. If you listen for the keywords, um, imbalances in say trade deficits, fiscal deficits, and ultimately this ever-growing, exponentially expanding public debt of the United States, and also you could say private debt as well, with households and debt, corporates and debt, all of that. Um, but the end game for that system, if you just continue running it, it ends in a U.S. commercial banking system default. And if you think about it, like that's what we were like doing with little stopgaps here and there along the last 50 to 75 years. Get rid of silver certificate redeemability into precious metals. Get rid of the gold window to redeem dollar balances in the global financial system into gold.
Right.
Clear that off, then what? Oh, you just allow the credit bubble to run and inflate from there. There's no more um, like steps to kick that can upwards without I guess like further like enforcing this central bank money onto the private economy, or you'd say instead of central bank, turning the central bank mechanism, the kind of 19th or actually 17th century technology for solving this Byzantine generals problem, right? That Bitcoin solves, which is really just coordination of trade. Um, you incorporate that into the state, and so the state becomes the ultimate issuer of money, and it just keep ramping up towards this technocratic, I guess, monetary
Right.
pipe dream.
Right.
All right. But in political economy, if the US commercial banking system ultimately defaults because all of these credit claims just outgrow the capacity of the actual productive resources in the economy, they eventually need to be marked down. Um, but that fall of the U.S. banking system, if your country's banking system falls or its financial system falls, that's equivalent, just the other side of the coin, to the fall of your constitutional order or your sovereignty, right? So if your banking system
Mm,
collapses, it's that same quote like Keynes, Lenin. They say the fastest way to demolish or defeat a society is to uh, debase the currency. And then you also get a social volatility, internal upheaval that comes with this. It's the historical kind of recipe for revolutions, instability, and loss of order. And it's very hard to put together the pieces after that. Like I'd say civilizations like France, they've still never recovered from the French Revolution of 1790s. So if you go that route, it can end very badly. Um, the asset-backed monetization of the dollar that Bessent is talking about, it will mark up like costs of resources in the economy as you go through that marking to market of all those, that over build up in credit claims that the legacy, Keynesian architecture produced. Um, but that debasement or markdown of the dollar will actually allow this current political order to preserve itself going forward, in my opinion, right? Or
I see.
gives us a better shot at that. So what actually breaks here is the old Eurodollar or offshore credit system that we talk a lot about, um, which has really been in effect. You can see it in U.S. history all the way back to like the Louisiana Purchase, right? If you look at it, it's a Eurodollar transaction if
Yep.
you dive under the hood. Um, but that's why this path is better. It gives the U.S. continuity, so we have something to hand off to our grandkids.
I see.
Hopefully, if they come
Right.
out someday.
So then what's the implementation plan here, right? So we talked about this new path. What are we seeing that's actually marching us towards that or down that path?
So I see it as 5 steps, and I'll kind of structure it as that. Internally, there's probably a project management plan someone's running. Um, but you can see it in the output of the executive orders coming out. So we'll go over those, and we got a key one this week, and it's all starting to come together. All right, so number one, you're first looking for the shift from or the shift toward risk or growth and innovation from like a risk focused inhibition to digital assets. I hate that term, but there's nothing better here. It's building out this new dollar on, call it crypto rails infrastructure, but
Sure.
you know, I want to say Bitcoin here because at the end of the day, that's where in my view, all roads lead to. We'll just keep using that term, crypto rails. But basically, so you shift the old order, which we'll go through what Biden laid out and was setting us, or the administration laid out and was setting us towards this fork in the road, where we were going to go CBDC route one way or private monies and stable coins on the other path. So first step,
Well,
stop going down that other path. Go, veer right.
and
All right,
before
go
you get
ahead.
into like some more details for our audience, maybe just for me, can you outline like what those headline like themes are, the topics that kind of Besant would need to hit upon with these EOs?
Yeah. So the five, right? So first is shift away from the Biden approach, do the hard right. So shift from risk first or risk focused kind of inhibition towards growth and innovation and utilizing the private sector or existing U.S. commercial banking system towards these digital assets rails. So
Mm-hmm.
that's first stage. Number two, I would say it's organize the existing kind of buildup of digital assets, but it's really Bitcoin that's been seized by federal government agencies, whether it's like law enforcement acts. They're sitting in, say, U.S. Marshals over here, Texas Rangers over here, just like asset seizures, all that stuff. They're sitting kind of unorganized throughout the federal government. Stage two is get that thing organized and run it through one department. And I'm going to argue Treasury supremacy right on this front. So that's number two. Wrangle everybody in this big political federal government bureaucracy and steer the cattle into Treasury's pen. All right. Um, Number three, you've got to figure out how to get the existing kind of banking and technology infrastructure. So FedWire, what was that new one? That FedNow, all
Fed
of
now.
that stuff. Figure out how to onboard that existing system with the new rails, the infrastructure for this private stablecoin dollar issuance. And get those two things kind of merged together or interacting together in a way that doesn't create blowups, risks, all that stuff.
I
So
see.
so like basically build up the regulatory policy so that those two um, different technology stacks can first integrate and talk to each other, but then they eventually become the same thing
Mm-hmm.
over the long run. All right. And then number four, you put in place bank regulation, tailoring to this openness for, I guess, this blockchain infrastructure, which we'll call Bitcoin, the blockchain, and stablecoin issuance. And then finally, like outright CBDC rejection and private sector stablecoin primacy.
Okay.
Right.
All right. So
So
yeah.
that would be the roadmap. It's going to take several, like this is a 4-year project, right? This is an entire presidential administration. So we're what, a third into year two.
Yeah.
This is this is a big project in it. Yeah. Getting this done allows for the 333,
I see.
in my opinion.
So then, yeah, help me. Let's go like topic by topic then. Like, let's just start with the first one. Walk me through what you're seeing from the Bessent side, or just from the, admin side that's pushing that roadmap forward.
Okay. So let's go to Cameron, the slide 5 on like this was the first executive order issued, but it starts with an order from the Biden White House in 2022 that set the course for where a different power faction, wanted to take the ball. And the key thing, what was the number for this executive order? It was 14067, if you want to
Hmm.
read up more on this. But the TLDR summary is that ultimately, like while it says in the header, we want responsible development of digital assets, what it was actually doing and the core of it was to assess and design work for a potential CBDC, right? So it was like policy beforehand was steering towards that CBDC route, which would ultimately lead towards policies that look more like what Europe is doing right now with the ECB. It says like it's anti-stablecoin,
Okay.
anti-Bitcoin. It wants to own the rails, own the blockchains, own the exchanges, own the infrastructure, and you interact with the ECB's money at the end of the day. It's fully under the control of the state technocracy,
For your
is where
safety.
this puppy leads. Yeah, for your safety, it's better. Trust Christine Lagarde. All right. Um, and then you get into, so this is the first executive order on this front that was released. And this was day 3 of the White House. So it tells you, all right, if you're pushing this on day 3, like you have the plan ready to go,
That's a
or,
top item for you. Yeah.
you're ready to start day running. Like this is your first week on the job, right? So this EO, it was 14178. It revoked that Biden EO 14067. It prohibited any like federal work, like any of these agencies from progressing on that CBDC front, just cold, uh, caught dead in its tracks. And it pivoted policy towards supporting, it says dollar strength, but private sector stablecoins and a pro innovation regulatory approach to digital assets. So right here, all it's doing, it's purely like direction of your executive branch, or like you could say a division of that, the U.S. Treasury also, but it's steering everybody towards this marching order. So it's basically like a management policy memo. Guys, this is the way we're going. Get in line.
Right.
All right. So that's step one. Um, Done. Day one. And then number 2, you get to that strategic use of federal held digital assets. So we talked about the monetization of the asset side of the balance sheet. This was a few slides. We can just pull it up really quick. It's the things most of us know are on the federal government's balance sheet: the gold reserves, federal lands, Fannie Mae and Freddie Mac, like spectrum rights, the Strategic Petroleum Reserve, which is coming into effect now.
Yeah.
As it did in 2022, just given the oil market tightness, all of that. Mineral rights on federal lands. These are all things that Bessent, they're in play when we're talking about that quote. We're going to monetize the asset side of the balance sheet for the benefit of the American people. Key one here, though, if you're doing private stablecoin or private stablecoins or dollar issuance on these crypto rails, you got to have a strategy for where all that value ultimately accrues, which, my opinion, we won't go into this argument here, but you've like ultimately it doesn't make sense to go down this strategy if you're not long Bitcoin at the end of the day. The more dollar IOUs you issue and crank up that number in this whole crypto space, you're just creating more liquidity. It's going to flow into the Bitcoin price. So you got to have a strategy for Bitcoin here. And that's where this executive order 14233 came out. This was issued in March of 2025. And I'd argue this one, if you think about one word or one phrase here, what it's actually doing is it's establishing Treasury supremacy over all these other government agencies. So I think about the federal government as like an uncontrollable fiefdom of different, I guess, kind of turfs or business operations, whatever. But those coins that were seized by the U.S. Marshals, well, what do they want to do with those? Well, um, it's kind of a free for all policy, undirected. This thing like wrangled everybody up under kind of the Treasury's authority, and what it did was it established like the government and its treasuries thinking about all of its Bitcoin that it's received through these, asset forfeitures, criminal actions, all that stuff, criminal law enforcement, um, formalized it into a strategic Bitcoin reserve so that, those hardware wallets, the private keys, they're not sitting, in a desk somewhere or someone's drawer or, lazy custody by the federal government. It's like, no, we're going to take this seriously. It's going to go and it's going to like, this is how custody is going to work. It's going to be reported, this chain of command and the treasury structure, all of that. Um, so it really established again, company policy. This is like your
Yeah.
CEO sending out a memo. Guys, this is the this is what's going on. If you're going to violate that, you're violating terms of employment, whatever, all of that. So that was what 14233 was. It directed all of that wrangling in. And then today, this week, talk about new. Um, that was executive order, which can be reversed by future administrations, right? It's not election proof. But today, or yeah, it was today. This was introduced Thursday, May 21st. Congressman Nick Begich from Alaska introduced in the House the American Reserve Modernization Act, or ARMA, right? And this is kind of an update, a more cohesive approach to this, strategic Bitcoin reserve thinking. Um, I think that was initially laid out and introduced as a proposal in the Senate by I want to say Senator Lummis. It was the Bitcoin Act, I want to say. So this is maybe just a little bit more expansive, give certain it would give certain rights, and like formally treat Bitcoin like gold on the federal balance sheet, where
Yeah.
it's a reserve asset. Like the executive branch, U.S. military, they take the custody of gold very seriously,
Right.
um, allegedly,
Right.
right? That's where it's stored in Fort Knox, West Point facility in Colorado. Gold's supposed to be there. Like if it's not, God help us.
Right.
But I don't want to go down those rabbit holes or entertain conspiracy theories. Let's just assume it's there. If it's not, we're
Yeah.
we're in a bad way. But this is really designating Bitcoin as a long-term strategic reserve asset rather than something the government could routinely auction. Say it, I don't know, treasury bill issuance or something like that. We run into
Right.
hiccups or like, hey, we need emergency funding. Well, hey, just sell the Bitcoin. It's deep and liquid. It's like, no, 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 no. Like, you got to think about Bitcoin as a long-term, um,
Reserve
y- you
asset.
know,
Yeah.
reserve of deep importance.
That's
All right,
two
that
of
just came out
the
today. Yeah.
themes then already, right? That's. I mean, you're seeing executive orders and actions directly related to two of those themes.
Exactly. And then you can also see the progress where it's moving from EOs, which is just, hey, White House cabinet, we drafted a memo. President Trump holds up signs it and has a little ceremony, and it's
He's got his pen.
it's
Yeah.
telling the organization this is the way we're going to do things in compliance with existing law, all of that. But now that we're seeing this in ARMA, like this is the approach to move that through. Like if you um, think about it like we're working towards concrete. Like this is all we want it to be written in stone, like enacted into law, so that this is like establishing a long-term political and financial
Right.
order that gives us stability and we can build around as a society, as a civilization. Like talk about America here. Um, but think about it like the executive orders are just you're laying the forms for the concrete, right? Nothing poured yet. This is like, oh guys, we ordered a concrete mixer. Cool.
Yep.
Like if we can get House to pass this, if we can get the Senate to actually do something and pass this, and then the president signs it into law, then we can pour the concrete and actually have something, have a solid foundation.
Right.
So you can see this kind of project chart working through. Um, and I think like it takes time, right? We're 15 months in, 16 months in on a 48-month process. So it's taking hold as it should. All right. The next front, Fed access for non-banks onto these new rails to merge the legacy architecture for financial settlement, clearing, all of that, credit relationships, Fed Wire, Fed Now, all of that with stable coins, exchanges, all this stuff. Um, you can see progress on this front taking shape out of those original like the direction of those executive orders. You see it in a speech here, October 2025, from Christopher Waller,
Yep.
Governor Christopher Waller, on the FOMC on the Board of Governors, uh, titled "Embracing New Technologies and Players in Payments." Um, we talked about the battle going on the Fed board. This is your tell on which side, as these votes become more and more contentious, on the margin, this is telling you where one of those seven is going to go. But these developments we're going to see, and we're going to get to an EO that just came out this week. You can see the kind of the thinking from existing board of governors, or some of them, they're veering,
Yeah.
towards the Scott Bessent direction, right? So they're picking up the
And the
wins.
thing I want to
They know
call out
which
with
way is
this
going.
is that this is Waller saying, like, in October, he's basically saying, I have this, there's this idea of a skinny Fed master account. Maybe that's a thing that we should consider. And he's
Mhm.
basically outlining, we're going to do some research into this to see if it's feasible, worth our time, etc. And then,
And then you literally saw, yeah, March. We talked about this story. It was on a prior episode of Mind Print Hash, but we didn't put it into the context of the big picture like we're laying out today. March 4th, Kraken becomes the first digital asset bank to receive a Federal Reserve master account. So what that means is like these new infrastructure, cryptocurrency rails companies are now onboarding onto the legacy, central bank access, which allows them to bypass kind of like gatekeepers of individual, say, commercial banks who were willing to work with these new technology companies are they're building out the infrastructure for ultimately these rails that Scott Bessent needs or his vision needs. I don't know if you say him directly. The vision needs
yeah,
or requires. Um, but that allows these companies then to bypass, say, the trolls might be, a too harsh of a term because they are giving access, but they typically you see this in Bitcoin companies' financials, crypto fund companies' financials. They were paying very high fees to access the legacy systems rails. So for this merger between those two things and integration to take place, we needed to see uh, kind of regulation and a push to give some oversight to make sure we could do this in a way that I could say safely, but that sounds like Christine Lagarde. Um, Basically, let's say not to cause problems, and I'll get into an example of one.
yep,
Um, but you can see this was actually the pilot to show what was coming, and we saw this week, slide 11. Um, Executive order. We're just listing out the executive orders here. If you want to follow along, jot them down. We'll put them in the show notes.
yep.
But this one is 14405. It's brand new off the press, so it's not even on the what's it called, Cameron?
Federal
The office
Register. Yeah,
record,
it'll
Federal
be
Register.
published officially tomorrow, I believe, if you're watching
Yeah,
this real time with us.
yeah. But this orders the Fed and other regulatory agencies, in the government, like government associated, right? Because the Fed is a quasi-public, quasi-private entity. Um, but it orders kind of the existing regulatory architecture, gatekeepers, all of that to prepare for crypto onboarding, to like central bank money access, or like access to the like central bank settlement. We call them like where banks hold their reserves. They use the Fed to settle with each other. Like that's what it is. It's a counterparty, where banking institutions, financials, whoever has access can use it as a venue, use the central bank as a venue to settle out their interbank monetary transactions, right?
Yeah.
So this step is really key. This week with this executive order, to figure out, like, not just from a systems framework, but legal, regulatory, and policy, how to put how to combine these two things or integrate them. And this is really uh, locking in or pushing forward that project towards supporting innovation and growth, as opposed to overly focusing on risk. That was kind of the policy framework towards crypto from the prior administration.
And you mentioned doing
All right.
this incorrectly could be really bad. So I know you have an example here. I believe we covered it in a previous Myprint Hash episode as well. But maybe do you want to explain for our viewers here what happened?
Yeah. So, all right, think about the Fed. Why do all these banks trust this Fed central bank to be their settlement mechanism, and where they are willing to park their reserves? And if you think about it, it's like it really just comes down to ledger integrity, right? You trust the counterparty in the middle not to have credit risk. And then you also are trusting them when you use a Fed wire, that they'll map, your payment from A to B. The accounting ledgers will be, um,
Accurately updated. Yeah.
free from errors, accurately updated, all of that, secure, so someone can't come in, hack them, overwrite them, etc. That's what's going on. So you have ledger integrity at the central bank layer. The commercial banks all trust that. And then let's say a commercial bank had crappy ledgers. I'll frame this in terms of my grandmother, who is no longer with us. But when you were on, like, prior to you know servers and mainframes that were processing all of these financial transactions, computationally, back in the day, like I'm like 1930s, 1940s, when my grandma was growing up, like, you'd go to your bank teller, you'd deposit, X dollars in cash, and you'd see a lot of bank errors. So my
Yeah.
grandmother, probably the last generation to do this, literally, like, managed out transaction by transaction
Yep.
and, like, plotted out their balance. They knew down to the penny
My
if the bank
grandmother
had
as
made an
well.
error.
Yep.
If they made an error, they call the bank, they fix it, all that. All right. Most of us in alive today at this point, those errors have been reduced via technology, and most of us don't waste an hour every week just summing up all of our transaction, netting out debits and credits, and double checking our bank balance. I know to the biggest extent now, it's check your credit card statement for subscriptions, all these fees, something you don't like. You're looking for
Things to cut
someone
out.
charging you
Yep.
that you don't want happening, is what we're doing now. But think about someone onboarding onto that architecture base layer. You're like, all right, you can run an accounting ledger free from error. All right, all of our members of this club also have to manage bank account, like manage their bank ledgers to 100% accuracy. And these are where state bank regulators, the OCC, they're enforcing that. Like, if a bank is building up balance sheet holes through crappy accounting, they're supposed to catch that.
Right.
Um, And that's why we have things like FDIC to backstop the like losses, all of that. So we've put in a lot of work over the last roughly 100 years to improve the like accuracy, integrity of this ledger money. And if we just start letting other, you know, crappy operators come in and onboard on top of that, bad things can happen. I'd point to the case in point, this Synapse fintech company. So what it was doing, Synapse was like sitting on top of a commercial bank. The commercial bank has to run a sound ledger, but then Synapse was allowing other kind of apps, fintech products. It was presenting itself to consumers, households, as a like FDIC insured deposit. They would earn interest rates, all of that. So they're like a neobank. They're presenting themselves as a bank, but their maintenance of their ledger, their integrity, it was pure crap. Like from a system standpoint, it was a giant mess. And what this thing ended up resulting in was as this thing went, it collapsed into insolvency. But what happened was you had over 100,000 Americans with 265 million plus in deposits. We didn't know who owned what, like just because that ledger integrity was so poor. So what we're doing here with this executive order 14405, we're putting in actual rules to make sure, all right, we know we need to, this is the direction we need to go on private stablecoin issuance. We're not going the CBDC route, but in order to get there and not having, blowups like Synapse every, 3, 4 years, we need to have structures, regulatory frameworks, rules, all of that to keep stuff like this hiccups from showing up, right?
Yep.
So that's 14405. Figure that thing out.
What's on deck?
It can be done, yeah. It, but it just takes effort, takes time. All right, on deck, the next step would be bank regulation tailoring, figuring out how banks are going to work with stable coins, all this Genius X stuff. Banks are still in process of figuring out this new world, um, and how they're going to update, change, pivot their own lines of business for Bitcoin and stable coins. I replace Bitcoin if you want to think about it in terms of crypto and
Yep.
blockchains. They're free to do that as well. But I think, my opinion, the ones that differentiate themselves against their peers will be those that embrace Bitcoin.
Sure.
Um, Figure that out. And then last will be CBDC outright rejection, putting that into, talked about that cement hardening, put that into law, and then establish private sector stablecoin primacy as this whole thing gets built out from the foundation up. So it's a big process we're going through, but we listed two of these things that happened this week, huge headlines. But today we filled in a little bit more of the background. The end goal, as we said, it's monetization of the asset side of the balance sheet of the federal government. Keywords for the benefit of the American people.
And I think putting all that together for me, we were talking before this episode. Matt was kind of laying out his thoughts on, how these all fit together. It really started to cement that for me. Otherwise, I think it's very easy to just see the headlines coming out like, okay, new executive order does something different. I don't know why he's doing it. This is like a very clear mapping of here's the executive order. Here's exactly why it maps into this framework that Bessent and company are trying to push for. So, thank you for that. And I think so. Then
Mhm.
now the question becomes, how are people responding to this? What is the international maybe take on what is going on here within the U.S.?
All right. So think about you're in business, right? How do you know if your product is working? Well, you're getting uptake from other customers, right? And so this is a key headline. This is this week. We're back in the present. Got the new tag in the left, just so everybody. We're going on a history retrace here, but this is another development this week. We saw Japan um, kind of tie off the last steps in its own kind of readiness for onboarding these, they're US dollar stable coins is what it amounts to, but onboarding those stable coins into its financial system as payment service rails within its own within its own banking systems interaction with international capital markets. When I say international here, Japanese banks interacting with U.S. banks or financial institutions. So the key thing this week was it wrapped up the last regulatory approvals to onboard US dollar stable coins issued by a foreign trust. So think of something like Circle or like the USDC coin, stuff like that. And this actually fills in a pressing need for Japan as you look at its own sovereign debt market. It's like the yen weakness, its need to import energy commodities. It needs a life raft. It's signaled like ever since the Takeichi election win back in September, October last year, the direction it wanted to go. Like we talked about the US election in 2024 being a referendum on the monetary path of the United States. That election with Takeichi was the same thing
Right.
for Japan. So it's adopting its own like onboarding of this whole vision, this framework that Bessent is really the figurehead or leader behind, in my opinion. Um, but it's really that if you're thinking about this in terms of like code production, this is your merge to mainline. Like it's actually coming in and going into effect. Like all the pieces are there for this thing to start running in production now, which means, ooh, Japan needs to import oil. A lot of oil is going to be produced out of the Gulf of America and Caribbean Sea, coming out of both the American producers, Venezuela, etc. How's Japan going to pay for that? It's
Could be a new,
lining
yeah.
up well for you right here.
Right.
Yeah, exactly.
Well, so then
So,
what's the
yeah.
response to this, right? Like, so that's obviously the pro stablecoin route. What might be the alternative to that?
All right. So your competitor, you always like you're competing in the product space, like as all businesses are doing. This one just happens to be money and settlement and payments. And if you think about the other kind of path we could have gone down, CBDCs, public money, and kind of the progression of the legacy system. All right, think about what we're seeing in the gold market right now. The markup in gold sounds a lot like monetizing the assets on the balance sheet of the United States, right? We supposedly still hold a lot of gold in
Yeah.
reserve. All right. The problem there is actually it's fractional reserve at the end of the day. You've got more paper claims on gold traded in futures, swaps, derivatives, etc., than there are actual gold bars in the vault. And what the kind of the system word for that in the like at the exchange level is unallocated gold. What it means is if you own a gold contract or a claim on a gold bar, it's not actually allocated to your account. You don't have a specific bar with a specific serial number. You just have a claim on a specific
Percentage
weight,
or
you
weight
know, a
of
number
the
of
total.
units
Yeah.
of bars in the vault and in a fractional reserve system, there's always more paper claims than there is actual gold. Similar concept in Bitcoin here. We're seeing it with a case Prime
Prime
Trust.
trust. Yep.
You've got more fractional reserve or more claims on Bitcoin than there are actual Bitcoin in vault or that you know your exchange holds the private keys to. We won't go down that route today, maybe a different episode.
Yep.
All right. So when I see this situation, so this is the reason, like the gold price is squeezing because there's a run on those bars of gold. This week, this was yesterday, we saw Hong Kong targets a July launch for its new gold clearing system. You say, ooh, new gold, right? Hear China, the Shanghai Gold Exchange, all of that, where massive amounts of volume and you know price discovery are shifting towards and taking place in the Shanghai market. This Hong Kong exchange, like notably, it settles trades they mentioned through unallocated accounts. So it's that same paper gold phenomenon on the bars of gold in the vault. They specifically mentioned plans to expand uh, capacity to 2,000 tons within 3 years, 32,000 ounces in a ton. Talk about 5,000 to $10,000 an ounce gold. Potentially as this markup process continues, roughly half a trillion to a trillion and settlement. Like think about that as like the thickness of the pipe of financial
Mm,
tractions that can settle
the
through Hong
bandwidth.
Kong.
Yep.
And then you think about what is Hong Kong actually? It's your connecting nexus of mainland China and its economic exports. Uh, they literally flow out of Hong Kong, like a lot of goods ship from there. But it's your also your financial nexus where the rest of the world's financial system can interact with the Chinese internal or domestic financial system. I say like mainland China,
Right.
CPC, all of that. Okay. And so this is really, in my mind, you're starting to see the two factions at play here in these two headlines. Tokyo aligning with the United States and its monetary direction, Hong Kong aligning with the legacy monetary direction, more of the same, right? So that's what I see here. And like and same thing as the Bessent plan, what he described on his first week in the job. Um, this is a story that's going to play out over quarters and years. It's not going to happen overnight, but you're seeing these slow movements in terms of which way each of these competing kind of financial systems, frameworks, economic blocks, all of that are going in direction.
Yep.
And then if you think about the Japan uh, kind of path as well, in my mind, we talk a lot about Paxilica. Tokyo is kind of your main gateway for like the U.S. interaction or the Western Hemisphere interaction as a financial center with the Pax Silica supply chains economy. We talk about those all the time. Philippines, Singapore, and is in all of that.
Right.
But same way we talk about Hong Kong as talk about the offshore dollar kind of nexus, like their systems gateway into mainland China. I'm thinking I am watching for Tokyo to emerge as the Western Hemisphere's nexus from a financial standpoint to interact with the Southeast Asian block of this bigger Pax Silica global supply chain that is the American vision for a 21st century economy.
Sure. Okay. And so then, I mean, we're talking about a lot of kind of future changes, things that are in progress, right? I mean, this is a multi-year plan, right, from Besant, and that you're seeing executed upon. So, how does that convert into kind of the short-term outlook that we're seeing in money markets?
Yeah. Okay. So one of the phrases you'll hear, you hear this from Obama, you hear it from conservatives as well. Every politician will say this. Um, Structural reforms or major structural reforms usually require a crisis, and that gives an implementation window. It's like, was it the David Axelrod quote back in 2008? Never let a good crisis go to waste. Like the crisis has happened, so these, you know, reshufflings, these big plans, these visions can be tested and ultimately if they're implemented, if they work, if the economics are sound, they'll last. If not, market will reject it.
Sure.
Just might take 100 years sometimes. Um, but what we're looking for, if you're thinking about, is there a crisis brewing? Doesn't have to be 2008 or 2020. Just has to be some window of opportunity, right? To push this kind of project chart to its, check more boxes off as complete. And so what I'm seeing in money markets as I'm tracking this, right? Everybody knows like, oh, CPI is running hot. Oil, $100, all those things. There's tightness in global commodity supply chains, just given like, the known, uh, Iran military actions, what's going on in Hormuz. But that's causing massive kind of volatility or pressures in global sovereign debt curves. We see that. We've been tracking that for weeks, most of us. Also, foreign exchange. If a country doesn't have a bond market to like, hey, run yields higher so we can protect the currency, which allows us, like our importers, to keep, waving in, commodities
Right.
on the global market. Um, you have to like if your local currency has a sovereign bond market that has depth, liquidity, et cetera, to tolerate that the rise in rates, means your currency can hold itself up, and then you can import those commodities. If you don't have that sovereign bond market or that backstop capacity, your local currency will have to take it on the face, and that's what you're seeing with like the Turkish lira, Indian rupee, et cetera, right? But as this inflation, right now it's rising prices just given the supply chain issues. Um, that itself has kicked up growth, but eventually that will turn over. Those high prices will start to slow down economic growth, and what you would expect to see that um, actually lead to in the money markets, in my opinion, is a flight towards safety as cash wants to go to ground. It wants to get under the mattress where it feels safe. So what do I mean by that? All right. And the dollar system, obviously, you've got banks, domestic and international, but think about this in terms of a money market fund, and it makes it pretty clear. Money market funds, like most of us know, they have to maintain par of their dollar. After we saw money market funds break the buck in the 2008 GFC aftermath, there's really only three assets they can hold now, largely just due to regulation that's been put through in the 2010s. You can hold treasury bills, you can hold um, you can lend into repo if it's treasury secured, and that's what SOFR is measuring as a market index.
Right.
And then third, you can park your cash at the Federal Reserve Bank of New York in their safe custody. And then on top of that, FRBNY will post its own collateral to you, which is one of its treasury holdings, right? So those are your three options. And if you look at these rates, I've got them up here on a chart. This is hard to see, but I've got a corridor here. You see that 3.75 on the top. Don't worry about that. The lower bound, the lower 3.5, I overrode it with my yellow circle. That's the RRP, the red arrow. That rate is at 3.5% right now. That's one of your options as a money market fund, and it's actually your safest option if you think about it. So your treasury bill itself, it's your risk-free asset. I've got the on the candles here, that's the yield on the 4-week treasury bill. It's your shortest maturity treasury IOU, the risk-free asset in this financial systems paradigm. The RRP is like the safest option, right? You park your cash at the Fed. They'll pay you a crediting rate. It's 3.5 now. That's the lowest number. It's the lowest yield. And on top of that, they'll backstop you. They'll be like, "Here, I've got my Treasury IOU. I'll post that
Right.
if you don't even believe in the Fed's credit worthiness." So okay, 3.5. Treasury repo is your next safest option, right? It's like, all right, I'll lend you $1 as a money market fund, but you have to post your T-bill to me as collateral, just in case you default. it'd be like one of your major money center banks lending to another money center bank. If you default, I've got your 4-week T-bill to fall back on. All right. And then last of your safe assets would be the 4-week T-bill. All right. You've seen over the last 7 days, SOFR has just run down to the rails of this lower bound, which is right now the 3.5% RRP award rate. Fed, if they want to go lower, they'd have to cut rates. And just given right now where the supply chains are, all of the volatility, you don't want to have to lower that quite yet.
Right.
So the response, if you go to, did I put this in there? Slide 16. Yep. Um, FOMC, what are they doing? Like they, what the FOMC actually does, they're directing the money market operations of the trading desks in New York. Like this is where your Fed guy, Joseph Wang, like this is where figures like him who come from that job, this is what they were doing. And if the money market managers of their three options, they're going to ground, they're bringing rates lower. They're saying, all right, I can hold more T-bills, more SOFR or RRP. They were at zero RRP allocations until this week. They started to move, out of those other two options. They've moved 24 billion into RRP to park under the mattress at the New York Fed. It's telling you like too much cash in money market. It's starting to go to ground. It wants to get defensive because it sees, the musical chairs game. It's slowing down, and think about it equivalently. Like the ships want to go into harbor where they're safe.
Right.
All right. And so, what do you do as the Fed right now? You don't want to cut rates at this moment. It will not be received by markets well into this. Um, the inflation is still from a CPI standpoint running hot. That's supply chain bottlenecks, like as we talked about, or the economists, the talking heads were talking about in 2022, 2023 when they talked about transitory or some truth to it. It was based on just supply chains gone amok. Same thing going here. Hormuz offline. Everybody's got to scramble and figure out how to get their resource access from wherever. Find out your next best option. What do you do right here? Like that whole thing hasn't fizzled out yet. You don't want to cut here. So what you might do if you're the Fed, and we know that the Fed since the December meeting has been operating reserve management exercises, right? You see the amount of
Yeah.
T-bills held on balance sheet starting to increase. What you could do to address this and just skew this mix, if all of your money market managers are shifting into secured repo, and then they're even going beyond that, when I say shifting into, they're shifting out of 4-week T-bills into secured repo, and then they are even going a deeper level beyond that. They're starting to shift into RRP. What you could do is just stop or slow down your reserve management exercises, purchases of T-bills on the balance sheet, let up. That would let your front end yields rise, and all else equal, those higher yields would entice your money market fund managers to allocate into the
Better.
4-week bill,
Yep.
where it was at, let's say, 3.575 on open today, May 21st. You saw this big run up in a matter of an hour. Oh, 5 more bips. It's like, oh, that becomes a little bit juicy. That alleviates some of your pressure of money market managers deploying it towards safety into overnight repo or RRP, and it extends some of your runway for that downward pressure at the front end of the yield curve. You buy yourself time is
Right.
what's going on here. I think ultimately you're gonna have to do what you're gonna have to do, which is probably cuts. If if the supply shock or just chaos from Hormuz starts to turn into or threaten growth, you'll eventually have to get cuts, but that day hasn't come yet. the window isn't open. What this is saying in money markets, we're seeing that like it's knocking on the door, but the system is just trying like it's extending this out. So what it's doing is buying time. But yeah, that's kind of you're seeing this action. It's playing out in money markets. It's in my mind leading against the kind of intuition to hike into an inflationary spike here, which is supply chain originated as opposed to uh, fiscal stimulus or uh, monetary expansion or like the true monetarist
Right.
definition of inflation. That's just at this point. The facts may change otherwise, but this is what I see money markets telling us right now.
Great. Well, I think, for our audience here, thank you again, Matt, for going through kind of your framework on what you need to see out of Bessent to approach that or hopefully accomplish that goal that he's put out. And I think even for me, understanding how that connects to kind of the different paths in terms of asset-backed versus debt-backed fiat finance was very, very enlightening. And then rounding that out with obviously the money markets, I think it's important for our viewers too to understand all of this stuff doesn't happen overnight, right? So even if Bessent does accomplish more of his goals, you still have the current fiat system that's in place across the world. So what Matt's talking about with these shorter term rates, things like that, if you're sitting there saying, hey, it doesn't matter, we're gonna get stable coins, we're gonna get Bitcoin, whatever it is, so this all goes away. That might not even be anytime soon. So I think it's
Mhm.
really good to be able to tie those back together, or helpful, I should say, to be able to tie those back together, especially for me, to here's what we're seeing short term and how that, how that might tip the scales one way or another in terms of where we go with that path over time.
Yep. So I think the takeaway, I'm going to bring it home. What you would see in prior eras, like when the system gets in this standpoint, when I say prior eras, everything we grew up with in the bond bull market from 1982 to 2021, the policy approach here was Keynesian fiscal stimulus, right? ZERP, cut rates, QE, and fiscal expansion. And I would just challenge us, all right, there's a different thing being built here. We're actually making, like, it's very clear now, we're making a monetary transition or attempting to make a
Yep.
monetary transition. And the policy steps here, um, we're not building the old thing or we're not preserving the old thing. We're trying to not let the old thing collapse, that's for sure. But we're also not trying to veer off course of the direction we're already going around. And I'll leave it as if the last time we were in this setting, right? Um, to get that Keynesian and technocratic and public money kind of policy package through, it took something like COVID, massive, to get us there. And then you'd say the same thing. It's like, well, the last time that happened, it was 2008, and you had to explode Lehman and all this stuff. And you say, all right, the other time to happen, it took September 11th. And so to get the result where we just see more printing, more QE, more like return to zero, but like lower rates here might be aligned with the direction of both paths. Um, but and then the fiscal stimulus, I don't think we have room to spend another whatever multi-trillion dollar spending package out of Congress. I think that turkey's fully cooked. Um, but my point is to get the same thing we got in like March 2020, money printer go burr, like it'll take a massive event in my mind to veer us back onto that course that we've clearly left behind. And as an American electorate, we also voted to leave behind. Many of us probably didn't realize that's what we were voting on in 2024, but in the big picture of history, that's what it nets out
Right.
to. So we've got a big important window coming up. This is where risk is high. There's a lot of uncertainties, and that's why you're seeing in money markets the analogy I like: the ships are coming into the harbor.
Great. Well, I think that's a good spot to leave it for the week. Thank you everybody for watching. As always, we're Mindprint Hash on Substack, on YouTube, on X. Follow Matt at Levered USTs. I'm on there as well. Uh, Hope you all have a great Memorial Day weekend. I've got a few plans here. I think Matt's got some plans with his family as well. So hope you all enjoy it, and we'll see you all back here next week.